The U.S. economy slowed in the second quarter of 2026, with gross domestic product growing at an annual rate of just 1.5%. That's down from 2.1% in the first quarter, and the slowdown comes as the war with Iran continues to upend energy markets, supply chains, and prices across the board. Oil prices have pulled back from their spring peaks, but the damage lingers. Higher gasoline and petroleum product costs are still hitting households and businesses. Persistent inflation and uncertainty over the Federal Reserve's next moves pushed bond yields higher this week, adding to the sense of an economy caught between underlying strength and mounting headwinds. The GDP report shows overall consumption remained relatively healthy, and business investment, especially tied to the artificial intelligence boom, kept plowing forward. An underlying core measure that combines consumer spending and gross private investment actually accelerated to 3.9% in the second quarter, up from 1.7% in the first. But as former Fed advisor Eric Wallerstein noted, real incomes and spending have been trending lower. Because GDP is adjusted for inflation, rising costs damped the headline growth number. This is the first estimate from the Bureau of Economic Analysis, and revisions can be substantial, especially during periods of price volatility. Financial researcher Varesh Kanabar points out that business orders and expenditures are rising, and retail sales have been strong for months. Yet when adjusted for inflation, consumer purchases are growing at a much softer pace. Over the past 6 months, real inflation-adjusted income has fallen overall at a rate not seen since the height of the 2022 inflation spike. In simplest terms, GDP tracks the exchange of goods and services, driven by business investment, government spending, net exports, and household consumption. Right now, that mix is sending conflicting signals: strength underneath, but real pressure on the ground. That's the latest from the Bureau of Economic Analysis. Thanks for listening.